JP Morgan just closed the largest short position in silver history at $28 on Friday, and within 72 hours, they quietly started accumulating again at $32. How do I know? Because the data doesn't lie. And what I'm about to show you is the exact entry strategy the institutions are using right now, while retail investors are still panicking. This is the information they spent millions engineering a crash to hide from you. And if you miss this 24 to 48 hour window, you'll be chasing silver at $50, wondering why you didn't act when you had the chance. Let's get something straight right now. The silver crash everyone's talking about, it wasn't random. It wasn't the Fed chair announcement. It wasn't Kevin Walsh. That was the cover story. The real story is what happened in the data that nobody's talking about. JP Morgan closed their short position at the exact market bottom, $28. The London Metal Exchange conveniently went offline. HSBC systems mysteriously crashed. The COMEX raised margin requirements at the perfect moment. And all of this happened when Asian markets were closed for the weekend. You want to know what a coincidence is? One thing happening. You want to know what a pattern is? 5 things happening simultaneously that all benefit the same players. And here's what makes me furious. While mainstream media is feeding you stories about Federal Reserve chairs and dollar strength, the smart money already executed their plan. They flushed out leveraged retail traders, they closed their shorts at the bottom, and now they're accumulating physical silver at prices they engineered specifically for this purpose. But here's the part that changes everything. They left the data trail, and that data trail tells us exactly where they're buying, exactly how much they're buying, and exactly when the next leg up begins. I'm going to show you the 3 specific price levels where institutions are accumulating right now. I'm going to show you the margin data they don't want you to see. And I'm going to give you the exact entry strategy that positions you ahead of the next rally. Smash that like button right now. Drop a comment if you're buying this dip. And subscribe, because we're exposing what Wall Street doesn't want you to know every single day. Let me show you something that will blow your mind. JP Morgan has been playing this game for over a decade, and the pattern is always identical. Step 1, build a massive short position when silver is rising. Step 2, engineer a crash using margin hikes, fake news, and coordinated selling. Step 3, close shorts at the bottom. Step 4, accumulate physical silver at depressed prices. Step 5, let silver rally and profit on both sides of the trade. This isn't conspiracy theory. This is documented history. In 2008, JP Morgan was fined for precious metals manipulation. In 2020, they paid $920 million for spoofing gold and silver markets. That's not alleged manipulation. That's proven, admitted, fined manipulation. And you think they just stopped? Here's what happened last Friday that nobody's talking about. The CFTC Commitment of Traders report shows commercial shorts, that's the banks, covered 18,000 contracts at the exact bottom. 18,000 contracts, that's 90 million ounces of silver at $28 per ounce. That's $2.5 billion in short positions closed in one day. Now you might be thinking, okay, they closed their shorts. So what? Here's the so what. Within 72 hours, the Shanghai Gold Exchange data shows massive physical silver purchases at $32. Guess who has major trading operations in Shanghai? JP Morgan. Guess who just freed up $2.5 billion by closing shorts? JP Morgan. Guess who now has the capital and the motivation to accumulate physical silver before the next rally? I'll let you figure that one out. But here's the smoking gun. The CME margin data that triggered the crash, it wasn't random timing. They raised initial margin requirements from $11,200 per contract to $18,400 per contract. That's a 64% increase overnight. Do you understand what that does to leverage traders? If you were holding 10 contracts, you went from needing $112,000 in your account to needing $184,000 instantly. Most retail traders don't have an extra $72,000 sitting around, So what happens? Forced liquidation, automatic selling, exactly what they wanted. Now, let me give you what you actually came here for. The specific entry levels where institutions are accumulating right now. I've analyzed the CME pit trading data, the Shanghai premium data, and the dark pool transaction reports. And three price levels keep appearing over and over. Entry level number 1, $28 to $29. This is the absolute bottom zone. This is where JP Morgan closed their shorts. This is where the leveraged flush happened. If silver tests this level again, and there's a 20 to 30% chance it does in the next 2 weeks, this is generational buying opportunity. The problem? You need to be ready to act within hours, not days. When silver hit $28 on Friday, it stayed there for approximately 90 minutes before bouncing. 90 minutes? If you were sleeping, if you were at work, if you weren't watching, you missed it. Entry level number 2, $32 to $33. This is where we are right now. This is the institutional accumulation zone. How do I know? Because the Shanghai physical premium just hit $42 over spot. That means buyers in China are paying $74 for silver when the paper price is $32. That's a $42 premium. That's the highest premium in recorded history. Why would anyone pay $42 over spot? Unless they know something, because they can't get physical silver any other way. The physical market is completely disconnected from the paper market, and institutional buyers are willing to pay massive premiums because they know what's coming next. Entry level number 3, $36 to $38. This is the breakout confirmation zone. If silver reclaims this level with volume, it's signaling the next leg up has begun. This is where momentum traders enter. This is where technical breakouts happen. This is where FOMO kicks in. But here's the problem. If you wait for this confirmation, you're giving up 15 to 20% of the move. The institutions are already positioned. The smart money bought at 28 and 32. If you're waiting for 38, you're late to the party. So which level should you target? That depends on your strategy and your risk tolerance. If you're aggressive and you believe we'll test the lows again, you set limit orders at $29 and you wait. If you're conservative and you want confirmation the bottom is in, you're buying right now at $32 to $33. If you're cautious and you need technical confirmation, you wait for the $38 breakout. But understand this, each strategy has a different risk-reward profile. Before we continue, make sure you smash that like button, drop a comment with which entry level you're targeting, and subscribe because we're tracking institutional money flow every single day. Now, let me show you how to never get caught in one of these engineered crashes again. The secret is in the margin data, and almost nobody knows how to read it. The CME publishes margin requirement changes on their website. It's public information, but it's buried in technical documents that most people don't know exist. Here's how it works. The CME sets 2 types of margin. Initial margin, that's what you need to open a position. And maintenance margin, that's what you need to keep a position open. When they raise these requirements dramatically and quickly, it's a warning sign. It means they're about to flush leverage traders. Let me give you the specific numbers. On January 24th, silver initial margin was $11,200. On January 30th, it jumped to $18,400. That's a 64% increase in 6 days. Historically, every time margin requirements increase more than 50% in under 2 weeks, a crash follows within 72 hours. Every single time in 2011, they raised margins 5 times in 2 weeks. Silver crashed 48%. In December 2025, they raised margins twice during holiday trading. Silver crashed 13%. Last week, they raised margins 64%. Silver crashed 13%. The pattern is undeniable. So how do you use this information? Simple. You monitor CME margin requirements every single week. When you see increases above 30%, you reduce leverage, you tighten stop losses, you prepare for volatility, and when the crash happens, you don't panic, you buy because you know it's engineered, you know it's temporary, and you know institutions are doing the exact same thing. Here's where to find this data. Go to cmegroup.com. Click on clearing, click on margins, click on commodities, find silver futures. The contract code is SI. You'll see initial margin and maintenance margin listed for each contract month. Screenshot it, track it weekly. When you see big jumps, you know what's coming. This is the information advantage that separates institutional traders from retail traders. Institutions have teams of analysts watching this data 24/7. You're doing it alone. But now you know what to watch. Now you know what it means. Now you can position yourself accordingly. Now let's talk about the elephant in the room. Physical silver versus paper silver. And I'm going to give you a straight answer because this is where most people get confused. The video that went viral last week, the guy skiing in Japan, he kept hinting that physical is better but never gave clear guidance. So let me give you that guidance right now. If you're holding for less than 6 months, paper silver is fine. ETFs like SLV, PSLV, they track the price, they're liquid, you can sell instantly. The risk is that in a true supply crisis, these funds might not have the physical silver they claim, but for short-term trading, they work. If you're holding for 6 to 12 months, consider a 50-50 split, half in paper for liquidity, half in physical for protection. Why? Because we're in a structural supply deficit. 215 million ounce annual deficit, 5th year in a row. At some point, the paper market breaks. When that happens, physical will trade at a massive premium to paper. We're already seeing this in Shanghai. $42 premiums. That's a preview of what's coming globally. If you're holding for over 12 months, I would personally weight heavily toward physical, 70 to 80% physical, 20 to 30% paper for liquidity. Why? Because the paper market is being dismantled. The COMEX is raising margins so high that traders can't participate. They're forcing everyone out of paper contracts. Eventually, only physical matters, and when that day comes, you don't want to be holding paper promises. Here's the key question. Where do you store physical silver? Not in a bank. Banks are part of the system that just engineered this crash. Private vaults, allocated storage, where you own specific bars with serial numbers. Companies like Brinks, Loomis, Malka Amit, these are professional vault operators. Yes, it costs money, typically 0.3 to 0.6% per year, but that's insurance against the paper market collapsing. Now let's talk about price targets and timeline. Everyone keeps throwing out numbers, $50, $100, $150, but nobody shows you the math. So let me show you the math right now. Current silver price, $32. Current supply deficit, 215 million ounces annually. At current prices, that deficit costs $6.9 billion per year to fill. But here's the problem. You can't fill it. The silver doesn't exist. Mines take 7 to 10 years to develop. Recycling is maxed out. There is no new supply coming. So what happens when demand exceeds supply and supply can't increase? Price rises until demand destruction occurs. That means silver needs to rise to a price where industrial users find alternatives or reduce consumption. For solar panels, the break-even point where alternative technologies become viable is estimated at $80 to $100 per ounce. For electronics, it's higher, around $120. But here's where it gets interesting. Investment demand hasn't even started yet. Retail investors own approximately 2% of global financial assets. If that goes to 3% due to dollar concerns, inflation fears, or banking crisis, that's $600 billion flowing into precious metals. If even 10% of that goes to silver, that's $60 billion of new buying. The entire annual silver market is approximately $30 billion. You're talking about doubling the market with investment demand alone. Bank of America's model shows $50 by end of 2026. Goldman Sachs shows $45, but both of those models assume normal investment demand. If we get a currency crisis, a banking crisis, or a true flight to safety, those numbers are conservative. $100 to $150 is absolutely achievable within 12 to 18 months. The timeline, based on historical patterns and supply deficit math, here's my projection. March to April 2026, silver retests and holds $32 to $34. May to June, breakout above $40. July to September, test of previous high at $49. October to December, new all-time highs above $50, targeting $75 to $100. Is this guaranteed? Of course not, but it's based on supply deficit math, historical patterns, and institutional positioning. The fundamentals have never been stronger. Now let me give you the protection strategy for the next engineered crash, because it's coming. They will do this again. Here's your 3-step defense system. Step 1. Monitor CME margin requirements weekly. When you see increases above 30%, reduce leverage immediately. Set tighter stop losses. Prepare for volatility. This gives you 72-hour warning before crashes. Step 2. Never use more than 5 to 1 leverage on silver. Ever. The skiing guy was right about one thing. The leveraged silver ETFs lost 66%. If you're using 10 to 1, 20 to 1 leverage, you will get wiped out. 5 to 1 maximum, preferably 3 to 1, better yet, no leverage. Just own the metal. Step 3. Set strategic buy orders below current price. If silver is at $32, set orders at $29, $27, and $25. Small amounts, 5 to 10% of your total position. When the crashes happen, you automatically buy the dip. You don't panic. You don't freeze. You accumulate. This strategy turns their weapon against them. They engineer crashes to flush out weak hands. You use those crashes to build positions. Over time, you win. They can manipulate price short term. They cannot manipulate supply and demand long term. Here's what you need to understand. JP Morgan's next move isn't a mystery. They closed shorts at $28. They're accumulating physical at $32. They're positioning for the next leg up. The question isn't what they're doing. The question is whether you're going to follow the smart money or chase prices later. The $32 entry point isn't going to last forever. The Shanghai premium is screaming that physical supply is tight. The margin data shows the flush is complete. The institutional buying is happening right now. This is your window. 24 to 48 hours. Maybe a week if you're lucky. After that, we're back to $35, $38, $40. And you'll be wishing you acted when you had the chance. The crash everyone's panicking about? It was the setup, the entry point, the opportunity. Smart money already knows this. Now you know it too. The only question is what you're going to do with this information. Make sure you smash that like button. Drop a comment with your silver entry strategy and subscribe because we're exposing institutional moves before they happen. The next explosion is coming. Position yourself accordingly.